All right, we are back. Let's talk futures. We are live with Craig Buick from the CME Group. Craig, how are you?
Hey, good morning, Jim. It's good to be back on your show.
Yeah, you took a little vacation there on us.
Yeah, a couple weeks, a couple different vacations. In fact, saw both coasts during the vacation, so that was kind of fun.
Yeah, nice, nice. And then you got and your son, of course, is doing his pre NHL tour right now, right?
Yeah, so we were out in LA a couple Mondays ago. We were in Miami this past Monday during your show, and then in between those two trips, we did a quick stopover in Pittsburgh to watch him kick off his season, his league kick off their season in Pittsburgh. So, yeah, we've been on the road a little bit.
Nice. By the way, I love Pittsburgh. I love the downtown there where the stadium is. It's all
It's
good.
a cool little town,
Yeah.
with some real like geography that we don't really have in Chicago. Um, yeah, I agree. They've done a good job with it.
Yeah, and that bridge coming into downtown is funky, man. It's
Oh, with all the exits and everything.
yeah, yeah.
Yeah, for sure. But yeah, I totally agree. It's a cool little town. I think they've got a pretty good tech scene these
Yeah.
days out there too. So I think the economy's doing well there, and I think
Yeah.
part of that's probably Carnegie Mellon being out there. But
Yeah.
yeah, it's cool.
All right. Well, we'll be on your son's watch list here. He's on our watch list here for hockey. So wish him the
Appreciate
best.
it. Appreciate that.
So Craig, we were thinking about, hey, what's a really important topic? And we do a lot of stuff about products and stuff like that. And one of the things that really gets me motivated is this conversation of why is futures trading and futures investing, right, better than ETFs? We have ETF commercials all over the place, ETF this, ETF that. But, and maybe I'm biased, but the futures markets are I shouldn't say infinitely, way better to consider as opposed to an ETF.
Yeah, I mean, and of course, I work for CME Group, so I'm going to be a little biased as well. But and I'm not here to sort of bash ETFs or anything like that. And I think there's a time and a place for everything. But I think there are some elements of futures and futures trading, that people should consider when they look at the two different asset classes. Just because there are differences. And again, I'm not going to sit here and say, don't ever trade an ETF or don't ever invest in an ETF. But, I think we're here today to talk about some of the characteristics of futures that people should take a look at when they're, looking at the different asset classes for their portfolios.
Yeah, and from a 30,000 foot view, the first thing is, hey, the futures markets aren't scary, right? A lot of people are like, oh, you're trading futures, that's dangerous, that's risky, we're scared. They're not, right? The price is here and the price is going to go up, it's going to go down, it's going to go sideways, right? It's a market, it's a tradable market. And then when you start digging deeper, and you kind of look at all the flexibility that you have and the benefits, and all of a sudden it's like, I get it right now, right? So we, on my side, we have this whole education effort that we are really focusing on right now, and there is so many benefits here, and I know you're going to tell us about a handful of them. I think we have a handful on the screen right now.
Yeah, I think you're absolutely right. And and lately I've been on the road at some kind of like industry events and stuff. And it's almost inevitable when I'm at, one of these shows or something like that, someone will come up and say, CME Group, what do you do? And we're a futures exchange and that kind of thing. And I'll hear, oh, future, just what you just said, Jim. Oh, futures are scary. I don't want an oil tanker showing up in my front yard, right? And there's this kind of perception for people that really haven't looked at it enough that think, oh my God, there's, delivery and there's expirations and all this stuff. And to be fair, that's all true, right? And if you are trading, for example, the WTI crude oil contract, you want to know when it expires. And if you're trading it at Ninja, I'm sure that the Ninja risk manager is going to make sure that you're not holding an open position going into an expiration. But, to be fair, an oil tanker is not going to show up in your front yard, but you don't want to be holding one of those open as we come to expiration in the future, for example, right? So I think it's just what you just said. It's just, taking a little bit of time to understand these nuances, because, you also made a point just now, it's a bit offer market, right? So if I look at an ETF like a Spider, or if I look at a future like an ES, they're both bid offer markets, right? One, there's going to be a bid price and an offer price. And on a future, there's going to be a bid price and an offer price. So from kind of an execution mechanism, they're very similar, right? Like there's limit orders and market orders and all that stuff. But, and we've talked about this a lot on your show, you have to know what, that future price represents in terms of dollar amounts, right? Like what's that, what we call a tick. But once you learn all that, because it's different than an ETF, right? If you buy one share of Spider, you buy, I don't know what it's trading at now, that many hundreds of dollars worth of a Spider. You buy one futures contract, and it's going to depend on that multiple. So these are things, right? And certainly I'll concede that these are things that you just have to learn. But once you learn them, I think then you get into what we're going to talk about today and kind of some of the benefits that come along with futures.
Yeah, no, for sure. I know. And it's funny, Craig, because we've both been in this for so long, especially me, really long, probably twice as long as you have, maybe three times. We just take a lot of stuff for granted, which we shouldn't.
We do, right? And I might have even mentioned this on your show, but like it kind of struck me earlier this past summer. My son actually interned here at CME, and one of the first things they did was they did a trading challenge with the interns. So in our test environment, our sim environment, all the interns got a sim account, and they had a contest for a week. And we were in the family room the Sunday night that it started, and he was kind of looking at the different markets, and I kind of flippantly was just like, "Oh, buy or sell some crude." And he goes, well, how can I sell something I don't own? Right. And it's these things that we take for granted, having been in it for so long, that just, aren't necessarily intuitive for someone that hasn't. But at the same time, they're not really that complicated, right? If you just sit down and just kind of take a look at what they are, you can figure it out pretty easily, I think.
Right. And to sell something short, this is the big thing. You don't have to borrow to own something to sell something short like you do in cash market, right? You're not borrowing from your broker and then charging interest rate. You are just getting short.
Yeah, so let's make that an unintentional segue into some of these different, elements that, are different between futures and ETFs. So one, and I don't even think I have it on this slide in front of us, but you're absolutely right. So, if you want to get short an ETF, or if you want to get short an individual stock, you've got to locate that, or your broker has to locate that stock. And sometimes it's not as easy to do that as other times. You've got to borrow that, which comes with borrowing costs, right? There's an interest rate associated with that, and then you can short something, but you're paying those associated costs with it. With futures, if you want to get long, you buy it. And if you want to get short, you sell it. And it's really that simple.
Yeah, no, absolutely. So that's kind of number one, like ease of participation, right? Click the mouse, you establish your position, right? Super easy to do.
Right, right. And again, it's, if you're not familiar with it, it's a bid offer market, just like you would be trading in stocks.
Yeah, right. And not only that, it's a transparent exchange. So you see the liquidity pool. You see it on your trading ladder, right? You can see the bids and offers. Whereas a lot of times in the ETF world, you're routing an order to a different ECN or a different exchange, and it's like, all right, well, this guy's bid's different than that guy. That guy's offer is different than that guy. So there's a real continuity in your execution cost and your entries.
That's right. I mean, it's as transparent as it gets, and you're right. Whether it's ECN or a liquidity provider or whatever, there's definitely a different market structure in the securities versus the futures. Where if you're trading, for example, the micro E-mini S&P future, and you put an order in to buy it, you're going to be in line in a first in, first out way with everybody else that's there. And it doesn't matter if you're ahead of a, $40 billion hedge fund, or, somebody else that's putting in a one contract order. You're in line, you're in queue in that spot. And if you were there first, you're going to get filled first. It's called first in, first out. So you're absolutely right. It's one central limit order book.
Yeah, for sure. So, all right. So you have some bullet points up here. Let's talk about that. Number one, management fees.
Yeah, and that's pretty straightforward, right? In futures, there's not management fees. ETFs there are, so you're paying some annual number of points on an ETF that you're not paying in futures.
Right. And even behind that management fee idea, there's real costs associated with that ETF in terms of how they how they position their ETF, right? How how they're hedging it, how they're providing it. So there's other hidden fees as well that no one even talks about.
Yeah. So I think maybe, moving on to the second one, which,
Yeah.
is one of the most important sort of characteristics of futures that we talk about is capital efficiency.
Yeah.
And, and I know you'll point out this can be a double-edged sword, right? Because another way to say capital efficient is leverage. Futures come with inherent leverage. And, and certainly, that comes with the necessity for very strict risk management when you're trading a leverage product. And you'll say it more eloquently than I will. But essentially, what we're talking about here is that when you trade futures, you put down what's called margin, but it's different than margin that you would put down if you were trading stocks, for example. So if you were trading securities, ETFs, or single name stocks, and you're trading on margin, you can put down 50%, let's say, under SEC rules. You can put, up to 50% in terms of margin. So in other words, you can get a loan for the other 50% from your broker. But again, that's a loan on which you're paying interest. So if you're trading stocks on margin and you put down 50% and the other 50% is your broker, that's a loan. With futures, our margin is what what we might better call a performance bond. So it's essentially a certain amount of money that we require somebody put up to kind of say, I'm good for this position. And it can, we have usually less than 5% on the screen. It can be 5%, 6%. I think our cryptocurrencies are a little bit more than that. But it's a fraction of what we call the notional value of what you're essentially the position that you're putting on.
Right. And how much of this index do you control? That's absolutely right. And the lower the margin, especially day trading, the riskier the trade is, of course. So we all know that. But from an investing point of view, think of it this way: for if I were to buy one micro E-mini S&P, and I think that overnight margin, Craig, correct me if I might be off a little bit, but it's around $1,450, something like that. Between the 1,500 and 1,400. Let's just put a range on there. I didn't look this morning. And then someone would say, well, you're only buying one micro with that amount of money. But I'm like, hang on a sec. The notional value, and you nailed it on the head. The notional value of that contract, you got to multiply the price by 5. So we're talking, a $28,000 notional value of one micro E-mini S&P. In other words, you're controlling with $1,500 that notional value of almost 30,000. So that's where that leverage comes in, but that's where that capital efficiency comes in as well.
Yeah. So in fact, if you flip to the next slide, then we can come back to this one. I have a very simple example, I think. So, what do we mean by margin? And instead of I think you just used the S&P as an example. I used the micro NASDAQ on this particular slide. So if you look on the left side, if you buy, and at the time, I don't know what the NASDAQ's trade this, I did this a couple of weeks ago, I think, but at the time the NASDAQ was trading around 18,590. So if you put on one micro NASDAQ contract, that's essentially 37,100. Again, at the time I did this $180 worth of NASDAQ exposure. And in order to hold that $37,000 worth of exposure, you had to put up about $1,800.
Yeah.
Now, if you look at this, oh yeah, go ahead.
No, so I just wanted to explain. You'll hear the word multiplier a lot for calculating notional value in different futures markets. For the stock index futures, in particular, the one we're looking at right now, the micro Nasdaq, it's the value of a point move on one contract, right? So you have a 2 there, right? If this were the classic Nasdaq, it would be a 20 multiplier. You'd multiply it by 20 to get the notional value. Here you multiply it by 2 because it's a micro.
Right. So if you were doing the mini, what we call the mini Nasdaq, that would be $370,000 worth of Nasdaq exposure. So a pretty big contract for a lot of individuals, which is why we introduced the micros, around, I don't know, I think around 5 years ago now.
Yeah.
But if you then look at the second column there, it says buy 80 QQQ, and I picked 80 to try to make that sort of notional exposure
Yeah.
similar between the future that we were looking at and then the ETF that we're looking at. So I think we all know that the micro Nasdaq future and the QQQs, in terms of like statistical price correlation, are going to be very, very, very correlated, probably approaching 99 to 100%. So essentially, you're kind of getting exposure to that same index. But in order to get the same amount of notional exposure, let's say it's 80 shares of QQQ. At the time, it was trading around $450. So about $38,500. But for that, you'd have to put up under that Reg T margin that we were just talking about, you'd have to put up half of that, which is about $19,000. So for the same notional exposure for two products that are statistically very correlated, you're putting up $1,800 or $19,000. And then, just for comparison's sake, I've got a typo on the third column. It should say buy 350 NVIDIA at 106.47 was what it was trading at the time, not 452. That was a copy and paste error. But at 106.47, if you did 350 shares of NVIDIA, which probably is going to be positively correlated with the Nasdaq, but my guess would be with like a different beta. But essentially, we're looking at tech exposure here. And I just did this for sake of comparison, again, to hold $37,000 worth of NVIDIA, $18,000, right? So just wanted to show that, what we mean by capital efficiency. And, I think this slide does a good job of underscoring that.
Yeah, no, this is so easy to understand. It's crazy, right? Because at the end of the day, you're looking for, you have your level of risk you're willing to assume, right? And then you have your profit target, right, that you're trying to achieve. And these two scenarios are going to give you the same result, except 1700 versus 19288. Anyway, let's go back up. Let's go back up to the main the bullet points here. Capital efficiencies were good with 24-hour trading.
So, I mean, I think we all know now. They used to say when the U.S. sneezed, the world caught a cold in terms of like economic performance. I think what's true now is that when anyone sneezes, everyone catches a cold, right? Like what happens here affects what happens in Asia, affects what happens in Europe. And just because the New York Stock Exchange closes at 3:00 in Chicago, it doesn't mean the market stopped moving. And it doesn't mean that something that happens overnight isn't going to impact your position and more importantly, your P&L. So this idea that futures are available from 5 p.m. on Sunday evening in Chicago through 4 p.m. in Chicago on Friday afternoon, with the exception of 1 hour every day, I think is really important. And actually the last slide, the third slide that I sent you, kind of speaks to how important this can be. So what I done, and I think, it's possible that, with the volatility that we saw about a month ago, we might have had a day or a night where we did actually as much volume as some of the nights that I've got on the screen. But at the time I did this slide, I essentially took the biggest, in terms of volume, the biggest nights that we'd seen in either the E-mini or the E-mini plus the micro E-mini. Some of these happened before we launched the micro E-mini. So in terms of volume, the biggest volume night that we'd ever seen, and this was the E-mini itself, was on November 9th, 2016, where we did 2.3 million contracts of E-mini volume. Well, I think we all remember what happened on November 9th in 2016, right? We actually, the CME kind of got a good commercial. I think it was Carl Icahn came out and said that he left an election party that night to put on a bunch of E-mini S&P futures. And he quoted some dollar amount that he made, like $10 million or something like that. So it was kind of, an unprompted commercial for CME, but he did that because that market was open as the votes started to come in for Donald Trump that night, when all the polls showed that Hillary Clinton was going to win that election. And, in terms of price range, just overnight, S&P's moved 132 points or $6,600 just overnight that night. So I think that speaks to how important it is to be able to get at your position, even when the sun's down here in the United States.
Yeah, and Carl Icahn made a big mistake that day. He could have had the NinjaTrader mobile app on his phone, place the trade, and not have to leave the party.
Absolutely. Um,
Anyway,
but
so
you
you
can
have other
see like
examples here
some
as well.
some
Yeah,
of these other
yeah,
events, right? Like in March of 2020 or 23, we had that volatility that was induced by the Silicon Valley Bank failure. On that
yeah,
night, we did 1.8 million contracts. And then some of the other ones, right? Like in February of 2020, when, it's starting to seem like, COVID was in the headlines, but not like what it became. I don't think been declared a pandemic yet, but we had some nights where the market moved. We had the Brexit vote,
yeah,
right, which was a big one,
yeah,
and things like that. So these things can happen, and with futures, you can get at your position, regardless of what time it is.
yeah. No, absolutely, absolutely. The first thing I do in the morning, the first thing I do in the morning, and I kind of get up early because I'm kind of old. I can't sleep a lot. I pull up the NinjaTrader mobile. I just go through all the major markets just to see what happened overnight. Then the second thing I do is I look at, to your point, what did the Nikkei do? Right? That could set the tone because, like you said, somebody starts crying or someone starts sneezing, everyone is sneezing. So that's the second thing I do.
Yeah, I mean, same with me, right? Because it tells you what's happened overnight, what the market's looking at heading into the open or
Yeah,
heading into the trading day. And it's just, and you see it on the financial news networks too. Before the stock markets open at 8:30 in Chicago, you see the futures price,
yeah,
because that's the indication of kind of where the market's, looking.
yeah, for sure. And you mentioned liquidity as being, you know, let's talk a little bit about that being an important element.
Yeah, so I think what we mean here, and I don't have the exact numbers in front of me, but and it kind of goes back to what we were talking about in terms of notional value. So if you look at like the E-mini S&P future and it's trading at whatever it's trading at 5,000 or something like that, in terms of like notional value traded, if we
Yeah,
trade 2 million of those in a day, it's not 2 million times 5,000, right? It's 2 million in terms of how much S&P exposure actually got traded. So it's 5,700.
yeah,
It's 5,700 times 50 on the E-mini
yeah,
times the number of contracts traded. So when you consider how big of a number that becomes, the dollar value in what we call notional value traded really becomes astronomical. And in a lot of ways will dwarf the related ETF in the cash market, even if you might see a bigger volume number on something like a spider that, I don't know what the per share price is, but that's volume on one share, right? And so when you really kind of look at the exposure that's being sort of transacted in the futures market, it really becomes astronomical.
yeah. I mean, and I was just showing the trading ladder. I mean, this is where the rubber meets the road right here. I mean, this is you see the bids, you see the offers, you see the spread between the bid offers is typically one tick, not always, but typically one tick, which makes it a tight market, which means your transaction costs are a little bit less than a wider market. You don't have this with these other financial instruments.
Yeah, I mean, when you say one tick, that's, in the E-minis that we're looking at, that's 0.25. So a quarter of an index point, which is $12.50 on a mini and $1.25 on a micro E-mini. And that's as tight as you can get in these markets.
Yeah.
And you're absolutely right, because if you're trading an illiquid market where the bids and offers are far apart from one another, those execution costs can really add up. So you
Yeah.
want to make sure that you're trading in liquid markets. And I think, what we just talked about kind of describes that the futures markets are in fact that.
Yeah, and same with the options markets for cash products is bid ask spreads. You don't even know what the bid ask spread is until they tell you what the bid ask spread is. Then you put your order ticket in, and then you click to confirm, and then all of a sudden it's a different bid ask spread. That's like not advantageous, not advantageous. But um, all right,
So then the, the,
we
the final one
yeah,
we've got on here talks
yeah,
about, and one of the things You know, I know you have Bob Iacchino on your show a lot, so I'll steal one of his lines, which, you know, we do some work with Bob too, and he'll say things like, "What's more correlated to the price of crude than crude?" Right? And that's, you know, when you're trading crude oil futures, you're literally trading crude oil, because when that contract expires, it's going to expire to the cash price. So you don't have any of these, you know, what we might call tracking errors that you might have with certain ETFs, where because of the way they're constructed and different sort of mechanics within the way they're constructed, you can have these situations where there's a little bit of a tracking error to what you thought was your underlying. Futures is very pure, right? If you're trading WTI futures, you're trading WTI. If you're trading gold futures, you're trading the price of gold. And if you're trading the stock index futures that we've been talking about a lot, those are going to converge to the spot stock index price when they expire. So it's a very pure way, I think, to get exposure to a lot of these markets.
Yeah, absolutely, for sure. And fly it here. We'll debate this a little bit later on our next segment. But you know, you have all of these hidden costs. You have the bid ask. Remember, Equity World, they sell order flow, and they have to make up for that order flow by changing the bid ask spread, and you're paying for it. We'll have that conversation later. But any event, Craig, that was awesome, man. I appreciate you being with me today.
Yeah, it's always my pleasure, Jim.
And I think you might be back next week. It's my hope, anyway.
I think so. I think we might be talking about our new Bitcoin contract that we launched.
Yeah, that'll be exciting.
Just all today, by the way.
All right. Oh, and so go ahead, give a quick plug. I know we're out of time.
We're calling it BFF, the Bitcoin Friday Future. So it's a smaller version of our current micro Bitcoin. And they're going to expire we'll have a contract out there that expires every Friday. And just overnight, I think we did about 4,000 or 5,000 in terms of volume on the first night, on Sunday night that we launched it, which is a really encouraging start to the contract. So I'll leave it at that. And we'll talk more about it a week from now.
All right. CME Group's new best friend forever contract coming
That's
up.
what they're saying.
Can't wait to check that out. Anyway, I didn't make that up just now.
Yeah, you did not.
All right. Anyway, thanks so much for being with us, Craig. We will see you next week.
The following presentation is for educational purposes only. All the symbols, trading ideas, and market commentary are for educational and demonstrational purposes only and are not recommendations or trading advice. Live sample trading occurs in a simulated environment. Past performance may not be indicative of future results. All the information and content presented is provided by NinjaTrader LLC, and the opinions expressed by all third-party guests are their own and are not necessarily those of NinjaTrader LLC. Trading futures involves substantial risk and may not be suitable for everyone, and trading futures can result in losses greater than the initial required margin. Traders should only trade futures with risk capital. Risk capital is money that you can afford to lose without jeopardizing your financial security or current lifestyle. You can find additional disclosure information on the NinjaTrader website.